All right, today we're going to talk about some of the best content we highlighted and some of our original blog posts and podcasts on Validea's Guru Investor blog for May 28th, 2021. And to start, I'll just get right into the article I wrote. The title of it was ARK Investments and the Potential Downside of an ETF Structure. And what I really tried to do there was just look at the massive growth and success ARK actually has had in terms of their ETF business. Most of their assets are in the ARK Innovation ETF. And then just think about some of the unique qualities of an ETF, which there's many good ones, including they're transparent, they're low cost, they can trade in real time, they're very tax efficient. Those are all the good qualities, but some of the things that, just given the size and the scope of the ARK fund, what some of those risks and concerns might be. So those are things like, they can't really ever close the fund because they would have to continue issuing new shares if there continued to be demand for the ETF, what influence that may have on some of the companies they own, both when those creation units or both when there's demand for the fund or when there's redemptions on the ETF. I looked at some of the holdings in the fund and how much of a stake ARK actually had in those. And then I sort of ended with the investor returns and how, because a lot of investors have piled in recently, the asset weighted return for many investors, I guess, or just the overall fund's asset weighted return, isn't that great because of that performance chasing behavior. So, these are all just, and you guys can go read the article, but it wasn't really, it's not a knock at all on ARK. It's really just like looking at this unique case and just sort of thinking about some of the characteristics that are unique to ETFs and how that might not be so positive in this case.
Like you said, ETFs are probably the best vehicle for almost any investment strategy, but like any type of investment vehicle, there are downsides to it. You did a good job in the article of highlighting some of the things here. This fund, the way ETFs work and the inability to close them means these focused funds that have very limited numbers of positions can basically grow out of control. I mean, they can grow as much as they want to, and there's no way for them to stop it. So that could eventually, it might not be with ARK, it might be with some other ETF, but I would guess eventually that'll probably be an issue in the market because a fund will grow beyond what it should have grown to, and then on the way back down, there'll probably be some issues. So, ETFs are mostly good for almost everything, but you did a good job of highlighting a few situations where in this type of niche case, they could be bad. What
was the podcast this week?
Yeah, we talked to Robert Cantwell of Upholdings. It's the Kings Compound Kings ETF. There's a lot of interesting things with this. One is we are, as quant investors, I always love talking to discretionary investors, and he runs a very, he's a believer in focused investing like we are, but he runs a very discretionary portfolio. And so we really got into how he selects, the criteria he uses to try to select these long-term compounders and how he looks at things like valuation and how a bunch of other things about his investment strategy. But also, it's very rare to see anything that has never been done in the ETF space. I mean, every ETF that could conceivably be launched has probably been launched at this point. But he's done a couple things in the ETF space that have never been done before. One, he took a hedge fund and he converted it to an ETF. And so we go in depth in that process about what had to be done, what the SEC required, how, the process of going from a hedge fund to an ETF and bringing all the investors with you. And the other thing is he's authorized to hold public companies. He was an investor in the Airbnb IPO in his hedge fund, and he was able to bring the private companies in to the ETF. And so as far as he knows, other than bond ETFs, there are no equity ETFs that have the ability to hold private companies. So that's pretty cool that he actually has two things he's done that had never been done before in an ETF. So it was a really interesting interview, and it's a really good learning process for us being on the opposite side of the spectrum as quant investors to learn about how someone like that looks at the market.
Yeah, one of the things that he said, we were talking about at the end of the podcast, we were talking about Buffett and how we've talked about with other guests we've interviewed, how Buffett attracts high quality shareholders. And Robert made, I thought was a really interesting point, something I don't think either of us had ever thought about, which is that's true, but a lot of Buffett's shareholder base, they're really like older people that have been with Buffett, potentially for a very long time. So when you think about who is going to take the baton from those investors, is it going to be today's younger investor? I mean, I think there's certainly a lot of younger investors that are huge Buffett fans, but it's just an interesting thing. Like he was like, Buffett's got to think about like almost like reinventing his, and I'm not, he didn't say this specifically, but like kind of like reinventing his philosophy, if you will. Although that's one thing I admire about Buffett is the consistency over time, but kind of reinventing it to become more maybe interesting to, the younger generation of investors.
Yeah, it's interesting. You want high quality shareholders, but you also want shareholders who invest with a long-term time horizon today to be very interested in your fund. And so, in Buffett's case, he may have a lot of people that have held the fund for a very, very long time. And so there's not turnover in the shareholder base. And so maybe those people who want like the long-term, compounding type approach from today, maybe they're not as interested in Berkshire. So I thought that was interesting. What was your article this week?
So yeah, it was a New York Times article. The economy is different. The economy is, in parentheses, almost back. It is looking different than it used to. And so what this article was highlighting, it was a pretty meaty piece, but it was just highlighting like, and everyone kind of knows a lot of this, but just sort of the economic winners and losers during the pandemic and how it's changed sort of spending behavior and habits. So, you have things like recreational goods, like up 26% first quarter, over, I think this is a year over year. So you have like recreational goods up 26.3%, information processing equipment up 23%, home furnishings and durable household equipment up 16%. So there's clearly a lot of demand for, goods in terms of doing things like campers and like pool equipment and stuff like that. People reinvesting and making their house nicer because they're at home more. But then you have obviously the negatives, which transportation, is getting crushed. Recreation services, stuff like concerts and stuff like that, down pretty significantly. Food and accommodations, down almost 20%. So this article was just really trying to peel back the onion and look at the areas of the market that have seen the biggest benefit and also the ones that have seen the biggest hit. And then sort of like implying like maybe some of these trends are going to be, with us for a longer period of time or longer than we think.
Yeah, it's interesting. I think about this a lot because we've obviously had a massive boom here in the economy, or starting to have one. And so the question is, will that continue? Will we just have massive economic growth going forward, or have we pulled some of this stuff forward? So effectively, if you think about pools as an example you used, are we going to have way more pools built now, or have we taken the people that were going to build pools in the next 5 years and we've pulled a lot of them into the current year, and maybe that that growth rate won't be sustainable, and pools will maybe go back down. And you can say the same thing about home furnishings and a bunch of other stuff. Is maybe we've pulled some of this stuff into the present, or maybe we're going to have a long boom. I mean, I don't have the answer to that, but it's interesting to think about it.
No, I think that's a fair point. I do think probably pulling some of the spending forward. I think that but you might have also gotten people that, well, we're home, we're not going to go to the public pool anytime soon, or our lake association or whatever, so let's build a pool. So I think it's kind of probably a combination of both in there. You got like some spending that is a direct result of people's like behavior changing about how they think about things, but then you probably have others that maybe they're thinking about it anyways, and they said, well, let's just do it now, there's no better time to do it. So yeah, it'll be interesting to see if these growth rates come down in some of these areas. What was your article?
It was called Robert Shiller Looks Back at the First Roaring Twenties. And it was interesting because he was sort of, Shiller's done some great work around narrative, and he was sort of looking at what happened in the 20s compared to what happened now, and maybe some of the similarities and some of the differences. Because obviously I didn't even know the exact numbers, but the 20s market was even better market than now. And obviously that ended in a pretty catastrophic end. And so the question is, are we in for a roaring 20s, but also are we in for that type of end? And so he looked at a bunch of different things. I'll just read a quote from the article. He said, "As great as this bull market looks on paper, Shiller describes the decade ending in March 21 as spectacular. The market in most of the roaring 20s was even better. Data shows a six-fold increase in the value between 1919 and 1929. So just a massive run in the market. And you have a lot of the same type of things that were going on then. He said people played the market as a grand game, abetted by technological innovation and new mass media. So playing the market as a game is certainly something we're seeing now. He talked about little scrutiny of fundamentals. So we're seeing little scrutiny of fundamentals now. People aren't really that concerned with the PE ratio of GameStop when they're buying it. They don't even know what it is. So we're seeing that type of stuff, but also that doesn't necessarily mean that this ends the way the 20s ended. And he said that. He said there's no particular reason to expect a market collapse that would be as bad as the 1929 crash. And one of the main reasons for that is, first of all, you don't see, that's a crash that we've only seen once, so you don't expect to ever see that again. But also, the Fed is much better now. The Fed made some serious mistakes. In that period that sort of led to that bear market being a lot worse than it otherwise would have been. And, the Fed is at the opposite end of the spectrum now. The Fed is being very aggressive and accommodative in the policies they're following. So, I don't think I don't think we should look for anything similar to that to happen. And, I don't think he's saying that either. But it is interesting to look at the parallels between that period and now.
Yeah, for sure. I mean, a lot of people don't realize like decades like the 20s and the 50s were just, huge decades for stocks. And hopefully, I think stocks were down like 80 or 90% during the Great Depression. So if it got that bad, we'd all be in trouble. Just given how many people in this country now, own stocks. I know the ultra wealthy own the majority of stocks, but stocks are definitely, more widely owned by people in the economy than they were, back in the 1920s. So anyways, guys, thank you guys for watching this, and we hope you enjoyed the discussion. We'll see you next time.
Thank you.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.